Insurance Australia Group is the leader amongst Australia and New Zealand's general insurers, historically generating the highest profitability ratios. However, IAG is facing a perfect storm of headwinds, which will prompt it to lose its shine, warranting a sell recommendation with a 12-month target of $4.32, which is a 12% discount to the 1-month VWAP. Over the last 5 years, IAG has divested its international brands to refocus on Australia and New Zealand, and also reduced its struggling commercial portfolio to refocus on its core segments of motor and home insurance under a range of brands. However, IAG's customer growth has begun to flatline as the company grows complacent, and we believe IAG's limited geographic and product diversification will be its downfall for future growth. IAG is particularly weakened in an industry that is faced with the dual effects of rising costs and reduced pricing momentum in a downturn. Generally, insurers will pass on the costs of extreme climate losses by raising their premiums. However, with the Reserve Bank of Australia affirming in February that wages growth will remain stuck below 2% for the next 3 years, household insurance spending will continue to fall. IAG's premium pricing makes it disproportionately exposed to customers switching to other brands. In the year to date, we've seen IAG's share price fall further than its competitors, affirming our sell thesis. However, it continued to trade at a 24% premium on a forward price to book versus ROE basis, and we believe IAG has further to fall. We issue a sell recommendation with a target of $4.32 and a 12% downside, based on 3 key drivers. First, IAG is expected to lose market share in its core products, as well as face rising reinsurance costs, which will cause IAG's margins to converge with the industry. And finally, with the devastating impact of lower for longer yields, IAG no longer deserves its historical premium.
IAG's struggling commercial portfolio has forced it to refocus on its personal lines, which includes home and motor insurance. However, IAG's personal lines will not deliver the desired 3% top-line growth due to aggressive competition and IAG's premium price point in an economic downturn. Within the commercial space, IAG is over-indexed to SME clients and thus hit hardest by the SME exits and downscaling following the rollback of fiscal stimulus and IAG's premium deferral program. IAG will be forced to exit the SME lines ahead of the planned remediation currently priced in by the market and effectively restrict them to their personal lines. However, within personal lines, IAG's motor insurance will suffer from a knock-on effect from aggressive competition in the compulsory third-party insurance market, also known as Greenslip. With half of Greenslip customers bundling with motor insurance, IAG's 6% Greenslip market share losses will have a severe flow-on impact on IAG's motor volumes as customers bundle with cheaper competitors. Further, IAG faces intense margin pressure in home insurance, where their leading market share makes them overexposed to the forecasted 21% contraction in dwellings approvals. Rising costs driven by heightened climate risk is also set to outstrip policy premiums, placing downward pressure on margins. Aggravating these factors, IAG also faces high switching rates as growth in their digital channels expose customers to online aggregators, making it easier to compare prices and policy coverage. IAG's 20% premium price point makes them unattractive to increasingly price-sensitive customers who are set to cut insurance spending by up to 12% in the ensuing low-wage growth environment. With the customer base shrinking and IAG unable to execute their traditional strategy of raising prices to mitigate volume losses, we anticipate a price-volume trade-off leading to a 200 basis point GWP compression in FY21.
Exacerbating issues with its top-line growth, IAG is set to experience rising cost pressures from both its claim and underwriting expense, brewing the perfect storm for margin compression. The threat of climate risk comes as no surprise, with this being years in the making, and IAG has historically remained unscathed. Leveraging its premium pricing momentum of 5% year-on-year increases across its portfolio, IAG has effectively passed on cost inflation to its customers, preserving its superior operating ratio. This, however, has come at the cost of becoming increasingly reliant on reinsurance coverage. Premium expense as a percentage of GWP stood at 15% in FY15, increasing up to nearly 40% by FY20, significantly higher than its competitors. With impending quota share renewals, management themselves have acknowledged prospects of higher reinsurance costs in their first half update. And all this while, markets have been blinded to IAG's poor ability to accurately estimate its natural peril budget, blowing out its allowance 11 times in the last 14 years, and the worst has yet to come. Being most exposed to a hardening reinsurance market that has been experiencing low return on equity after years of high payout, IAG's aggregate catastrophe cover is really shrinking, putting downward pressure on IAG's loss ratio to realign to industry average levels of 70%. Additionally, with the optimization program at its end, we see that markets have significantly over-anticipated the scope for further cost reductions in its underwriting activities, offering no saving grace for a company in the midst of a tough insurance cycle. With IAG stuck between a rock and a hard place, it will lose its fight to preserve its margins, and its price on book premium would no longer be warranted.
Beyond underwriting, IAG's investment income will continue to face its own challenges amidst an effective lower bound environment, expected to push realized yields to unprecedented lows. IAG's underwriting profitability has historically allowed income earned on policyholders' funds, the funds backing their insurance liabilities, to flow directly to the bottom line. But this income stream is expected to fall almost 50% from FY20 levels, failing to recover in line with underwriting profits. Following 115 basis points of rate cuts since the start of FY20, Australia's cash rate now rests at the effective lower bound, where Reserve Bank commentary indicates it is expected to remain until at least FY24. While markets are far from blind to this fact, the impact of lower for longer rates is yet to be unmasked, with capital gains on held instruments so far more than offsetting lost yields. However, this unsustainable trade-off will soon unravel, as the lower bound leaves no room for further instrument appreciation. For IAG, this lost yield will begin to materialise immediately, with $425 million of annual yield deficit expected by FY24, as 75% of owned instruments mature in an effective lower bound environment. Turning now to shareholders' funds, those in excess of expected claims but required for regulatory purposes, this low yield narrative is echoed. A recent reallocation in response to market volatility leaves 80% of the fund trapped in fixed income, and contrary to market opinion, we see it staying this way. A re-risking is just hard to justify when equity is costing you 7% to earn a potential 6% on high-yield corporate credit or a highly uncertain equity return, especially where these attract an 8 or 16% risk charge from the regulator. This is further unsupported by a contracted credit fan, undermining any strategy of simply moving across investment-grade spreads. All in, we expect shareholder fund returns to fall 30% from FY20 levels.
We valued IAG using a residual income model, dividend discount model, price on book versus row regression, and equity multiples to imply a target price of $4.32, a 12% discount to the 1-month VWAP. Acknowledging the continually uncertain macroeconomic environment, we sensitize our valuation to key drivers, including GWP growth, reinsurance and claims expenses, and fixed interest yield. However, withstanding these optimistic assumptions, our bull scenario generates a limited 5% upside. Risks to our sell thesis include investors likely regaining confidence in future underwriting profit growth if IAG were to persist with price increases whilst preserving retention rates. However, we see increasing customer churn during the current downturn as challengers take advantage of the flight to value in insurance policies, minimizing this risk's impact on our margin forecasts. Outside of market risks, significant ESG headwinds exist for new CEO Nick Hawkins. In the aftermath of its Swan Insurance debacle, IAG have strengthened its social pillar through premium deferral and forbearance programs. However, IAG is a lone mover in this space, with both Suncorp and QBE withdrawing from increasingly risky rural books. As IAG attempts to convince the market of its nil exposure to green steel credit policies, we see its prime mistakes on pandemic contract wording casting doubt on IAG's underlying governance. These uncertainties will continue to compound stock issues, particularly for fund managers with tightening ESG mandates. In sum, IAG has lost its shine and no longer deserves its historical premium. A restriction to low-growth segments and geographies will prevent market share growth. Rising cost pressures will compress margins beyond consensus forecasts, and lower for longer interest rates are a red flag for IAG's investment sleeper. For IAG, the underwriting is on the wall. We are from the University of Sydney. Thank you for listening, and we now open the floor to any questions.
Thank you. Judges, at this time, please turn on your video. Stay muted unless you are speaking. I will start time as soon as the first judge utters the first word. You'll have 10 minutes. Feel free to begin.
Hi, I just want to start with the first question on slide 15. Could you explain a bit how you come up with the weight you put on the 4 different valuation models?
Absolutely. Thank you for your question. So just overall, we have a 50% weighting to our fundamental methods and a 50% weighting to our relative methods. So on our fundamental side, we have 40% for our residual income model and 10% for our dividend discount. The reason for that is that whilst IAG have historically played a constant stream of dividends, the cash NPAT, especially in FY21 and FY22, is quite volatile. And therefore, we don't see that the DDM provides too much more robustness over the residual income model. What we recognize, though, is that the insurance sector in Australia is quite small, with there only being 3 major players. And therefore, we've also looked at a relative valuation, which comprises both domestic and global peers. And if I can quickly take you to slide 72, please, Seki. So for our relative valuation on that right-hand side, we've assigned a 40% to our Australian pure play players, which are IAG, QBE, and Suncorp, 30% to our broader insurers within Australia, and then we have a 20 comp set of global insurers, which we've handpicked, which are select insurers across America and Europe who operate in similar growth margins and are property and casualty insurers for IAG. So taking all of those together, we still have an equal weighting between our fundamental and our relative, and we hope that we are able to then isolate the specific drivers of Australian insurance and IAG, whilst also considering the broader market landscape for property and casualty insurers globally.
Got it. Thank you.
You mentioned a couple of times the pricing premium that IAG has. Has this delivered them superior profitability? And why do you see it as being such a significant risk now across both auto and home?
Yeah, thank you for your question. I'll move to slide 36. So the reason, in terms of the first part of your question, they have had a pricing premium in the past, and in whether it's contributed to a higher profitability, I would say yes, it has contributed to higher profitability for IAG in the past. However, we don't think that's sustainable, and that's why we have the sell recommendation, because of several reasons. First, the pricing premium at the moment coincides with consumers wanting to cut insurance spending by 12%, because like the 6% 6% price hikes actually outstrip the wage growth of 1.25% in Australia. And that's actually contributed to people cutting insurance spending and also going to challenges, which leads me to my second point. So people have been wanting to go to challenger brands such as UE and iSelect, especially in these recent months, because following the Royal Banking Commission, consumers are more aware that big banks and especially big insurers are overcharging on coverage that they don't actually need. And I think, in this current environment, those two factors are the main factors why we don't think that they can rely on a pricing strategy to really boost their profitability going forward. If we move to slide 103, where I look at the margin analysis for both motor and home insurance. So in home insurance, we see that IAG's 29% market share makes them over-indexed to dwellings approvals, but also the customer switching is expected to contract volumes. So the management in the first half results have flagged that they're actually lagging some of their competitors, such as QBE and Suncorp, in terms of the GWP growth in the space. And then there's cost pressures that I outlined, such as climate risk and also working from home shift, which has led to higher claims, such as fires, which are more expensive than theft. And then in motor space, there's a knock-on effect from that green slip market share losses, which I think the market has missed, because it's quite an overlooked relationship between motor insurance and green slip. And then also cost pressures include increased driving above pre-COVID levels due to increased awareness about hygiene. Thank you.
One question from my side. So, low interest rates is an issue for all the insurers in Australia and globally. And you mentioned that AIG has higher insurance margins compared to Suncorp, QB, their major competitors, and they still generate significant underwriting profit. Would they be able to try to consolidate the industry by buying a smaller insurer, maybe with some growth exposure, or try to re-enter into some of the growth markets with higher growth? Can you comment on that, please?
Yeah, so thank you for your question. I guess to address the acquisition story, if we have a quick look at slide number 1 here, on the left, all the light purple markets are markets where they actually attempted to enter and had subsidiaries for some years. And what we put their lack of success down to is that they effectively tried to replicate their Australian insurance model in overseas markets. And their Australian insurance model was, we are the preeminent Australian insurer, we can charge a premium price point and you will pay for it. When you try and replicate that in an overseas market as a newcomer, it's obviously very, very difficult to justify. And that's why we see issues with the top line growth. As far as why they're particularly exposed to the low interest rate environment, as I appreciate, all insurers are exposed to this issue. If we have a look at, apologies. If we have a look at their allocations between fixed income and equities and alternatives, we can see in recent years, they've upped that fixed income allocation to 80%, and that we expect it to stay there. And if we look at other insurers, Suncorp in particular, they actually have a banking arm attached, and that not only do they feel more comfortable in riskier asset classes, but they also have that to subsidize their insurance division.
Just to add on to Seki's point on the acquisitions internationally, domestically as well, IAG faces 2 issues. So firstly, there have been some divestments from banks of their insurance arms. However, because of IAG's big market share in Australia, the competition boards and legislation prohibits them from acquiring these players. So that's a big hurdle for them to actually acquire any banking insurance arms. And secondly, for challengers, they've tried to acquire very small tech players to innovate their business. However, this has not actually led to any market share growth. And we've actually seen very limited management, talking about how these, VC type investments have generated returns. So we think that's a red flag as well, that IAG can't innovate from its, very big dominant market share in Australia.
Thank you.
Thank you for your presentation. A couple of quick questions. On the cost side, what's their ability to continue to reduce cost by digitizing? They do have a fairly large brick and mortar presence, so that could help maintain margin. And apologies, a very related question is, do consumers have a choice to actually reduce expenditure on insurance, given the high risk on now fires and other climate risks? So they may be actually forced to continue buying insurance, even if the prices are going up.
So I'll be happy to take the first portion of your question with regards to its cost base. So if we flick to slide 47. So currently, we do note that IAG has been historically trying to, reduce its underwriting expense through its optimization program, and it has had some success in the past 5 years. But we really do see this to be a bit more troubling moving forward, just for 3 main reasons. So first of all, we do see that the regulation and compliance expense will continue to increase in the next foreseeable future. Just after the World Banking Commission, the whole saga meant that IAG had to have, more regulation compliance expense to mitigate some of those risks. Moreover, we do see that right now in the COVID-19 environment, we're also seeing a reversal of its offshoring trends, which had been a key driver of it, reducing its underwriting expense. And with the COVID-19 pandemic, some of these foreign countries hasn't been able to secure good, working environment. So in a sense that, a lot of border restrictions are still in place, and therefore a lot of these offshoring actually has to come back to Australia. And finally, we do see that with its claimant system, that also have been a main driver of its consolidation efforts. And this has already completed. So we do see that from its optimization program perspective, this may be a bit more difficult moving forward.
And for the second part of your question, yes, people can reduce their insurance spending. And in fact, because there are more bushfires, the price of insurance, especially home insurance, has gone up exponentially, up by up to 150%, particularly in regional areas.
Thank you, University of Sydney.